Hi everyone, thank you for coming out this evening to learn about trading altcoins profitably and hopefully not getting wrecked. My name is Arthur Hayes and I'm the CEO of BitMEX, the Bitcoin Mercantile Exchange, and we're one of the largest Bitcoin/cryptocurrency derivatives trading platforms in the world. And today we're going to be going over some simple arbitrage strategies using altcoins. So a bit of housekeeping. It's a small group here, and this is meant to be a seminar, so please ask me questions. Interrupt me while I'm speaking if you have a question. Some of these concepts are new for a lot of you, unless you trade professionally at a bank. So questions are good. Please ask them, or else myself and you and whoever's watching doesn't get as much out of this presentation. Alright, so just a basic, what are altcoins? So obviously most of us are familiar with Bitcoin. Show of hands, how many people own some Bitcoin? Alright, cool. How many people own a coin other than Bitcoin? Alright, so when I refer to altcoins, or more colloquially I call them shitcoins sometimes, because I'm a hater on a lot of coins. I'm basically talking about a currency, a coin, or a token other than Bitcoin. And I guess up until a few months ago, Bitcoin was about 80–90% of the market cap of all digital currencies that exist. And this year, 2017, the altcoin complex has sort of surged higher. And now I think Bitcoin is around 50–60% market share of all digital currencies, which basically means that coins, some of them I've listed here in the top 5 by market cap, I think at least 3 of these are US billion-dollar market cap coins. So, you were talking about Ethereum this year has gone up 10x. Ripple, which is now the #2 most valuable currency, has gone up a lot more than that this year. It's absolutely insane. Yeah. So this is it's a crazy market, and which is why do we want to trade these other currencies besides Bitcoin? A lot of Bitcoiners who believe only in Bitcoin, Bitcoin's the best, it can do everything better than anybody else, think every single other coin is worth essentially zero. And they're all scams, they're Ponzi schemes, there's pre-mines, there's all sorts of issues with these coins. However, there's a very vibrant trading market. And as traders / arbitrageurs or market makers, what we want is illiquidity and volatility, which are the two things that altcoins provide. And when you have illiquid and volatile market, you get a lot of pricing inefficiencies. And that's what I'm going to be talking about today, is how to capture those pricing inefficiencies and earn income in Bitcoin. So if you've come to some of my other talks, I talk about how to take your US dollars, entering the cryptocurrency space, and earn a return essentially benchmarked in US dollars. Now I'm taking it one step further. I'm assuming that you are a Bitcoin holder, you've got some Bitcoin sitting around, and now you're thinking about, what am I going to do with this Bitcoin that is sitting in my wallet? Am I going to play dice games? Am I going to go bet on the NBA, speculate on some derivatives, or do I want to earn some passive income intelligently using what's going on in the altcoin space? So these strategies are all going to focus around futures contracts. So for those of you who don't have an idea what a futures contract is, essentially, it's a contract that allows you to speculate on the future value of an asset or a currency pair. Now, on BitMEX, we obviously allow you to go long and go short with leverage, meaning you don't have to put up the full value of the trade when you want to trade. It's purely in the contract setting. So BitMEX, we're famous for having 100x leverage on our Bitcoin dollar pair, meaning if I want to trade a position worth 100 Bitcoin, I only need to have 1 Bitcoin of equity sitting on the BitMEX platform. The second very important thing to note about BitMEX is that every single one of our futures contracts, regardless of what the underlying instrument is settled in Bitcoin. So if you take your entry price minus where you exit, hopefully you've made a profit. That profit will be denominated in Bitcoin. So you enter with Bitcoin, you leave with Bitcoin. And that keeps things very simple and straightforward, especially for everyone who benchmarks themselves in Bitcoin. So these are 4 identities. That is the fundamental building blocks of every strategy that I'm going to talk about today. And if you don't understand these, what's going to follow is going to be a little difficult. So the first and most important identity about any futures contract is that it has to equal the underlying spot price at settlement. If it doesn't, then it's not anchored to anything real. If I said, hey, come and trade a product on BitMEX and there's no expiry date, you're like, well, how do I know that this futures contract is ever going to equal something objectively real on another pricing platform?
Sorry, I'm quite new to this. I mean, there's many so-called exchange for Bitcoin. How do you define this so-called underlying spot price of Bitcoin?
So when I'm
because
talking,
maybe this guy give you one spot price, the other guy give you another spot price. How do you define this?
so us as the exchange will produce a specification called a contract specification. And on this contract specification, it will clearly state where the underlying price for this futures contract is. Okay. So I'll go through one in a minute, but for the altcoin space, the most popular spot trading platform, meaning I can take my Bitcoin today and exchange it for an altcoin and take immediate delivery of that altcoin. That's what I mean by the spot market, immediate delivery market. That is the basis or the underlying asset for the majority of our altcoin futures products. So on settlement day, XYZ contract will look to the preliminary spot rate and say that's the price that this contract equals at settlement, and that's where everyone's P&L or profit and loss is benchmarked against.
Yeah, this has actually been a point that I've been looking into BitMEX for the last year, and this has been a point that has slowed me down for my adoption of the platform. Trying to understand exactly how the spot price is computed for especially Bitcoin, because that's the biggest in the market. So you had it's changed. The formula has changed over time. Is the formula published on an API that can be accessed and updated regularly, or is it? Because I looked at the website for the spot price definition, and it was all in text, and it says specifically on the website it says this is subject to change.
Yeah, so Bitcoin is an ever-changing landscape, and what I mean by that is exchanges get hacked, exchanges close, and exchanges lose their banking facilities. All 3 of these things have happened in the last 12 months. So if I told you that my contract is based on the Bitfinex Bitcoin US dollar spot price, in August of last year, Bitfinex lost $120 million US dollars. Is that a credible place to be basing a futures contract on? No. So we removed them from the index. 9 months later, they got their act back together. They rehabilitated, paid everyone back, got in the index, and then unfortunately, them alongside other exchanges, namely OKCoin, lost their ability to accept US dollar deposits and withdrawals. So if you have an exchange and one half of the currency pair that is the spot price is no longer available to be withdrawn or deposited into, again, that exchange is not valid. So we have to remove you from our calculation index.
Is the formula for the spot price?
Well, the formula essentially is we'll define a basket or a universe of exchanges that represent this spot price. So let's say that right now we have for Bitcoin dollar, we have Bitstamp and we have GDAX, aka Coinbase. And we say that we'll take half of the price from one and half of the price from other, do a sum, create our spot index.
Is the formula going to be changed, like, I don't know, subject to...
Well, we always are trying to create a robust representation of where you can exchange Bitcoin and altcoins for immediate delivery. So in the Bitcoin space, because there's a more, I guess, vibrant, liquid, efficient market, we like to have more than 1 or 2 exchanges. So as exchanges meet our liquidity profile, we will give notice and add them to the underlying spot price.
Is it always a flat average?
Well, it's always going to be some sort of arithmetic mean of a set of exchanges. Similar to if you trade exchange-traded funds, say the HSI. You have, I don't know, there's 42 stocks, and each has a weight You do a sum product, and then you get the price of the underlying basket of those stocks. So it's a similar concept. But for altcoins, because the market is much less developed, and there's one very clear leader in terms of volume, aka Poloniex, we only have one exchange that is the basis for this underlying spot price. So it's a lot more transparent and easier than when you come to Bitcoin, where there's a lot of different platforms all over the world that have similar liquidity profiles that we use to create our underlying spot price. So
is the historic underlying spot price be available for?
Yes, so we publish these in indices. So essentially you can query, so for our Bitcoin it's .bxbt. We're all ex-bankers, so we're used to writer's Ricks, so that's where our notation comes from. So if you basically run our API, you can get historical tick data for these underlying indices.
How about the formula?
Right, we will be exposing it on the API shortly, so you'll be able to consume that over our REST and WebSocket, a dynamic weighting of what is included. So the second identity is basis. And now this is what you're going to be looking at constantly as an altcoin arbitrage trader. And essentially that's the difference between the futures price and the spot price. Different people will define basis either spot minus future or future minus spot. I come from equities, it's future minus spot to us. And that's how we think about it at BitMEX. And then we can go down one step further and talk about contango, when basis is positive, futures price is greater than spot, or backwardation, when the futures price is less than spot, or that's the same thing as saying basis is less than zero.
Sorry. I think my question is more on the infrastructure stuff, right? Like in terms of like the clearing, settlement, the kind of thing, right? Because like I know, like because we worked in the bank before, we have a huge team doing all this like future like settlement. For instance, like sometimes can be blow up, right? I'm wondering, I mean, do we have like enough, I don't know, like kind of infrastructure team to back up your future business?
The reason why banks take forever to process trades is because they built very bad tech and they compensate for it in lots of people. Lots of people who make lots of mistakes. And we do not have that same philosophy. We build very good tech that requires very few people. So Ben, our co-founder over here.
So everything's like STP and...
Yeah, everything's STP and the settlement's done in real time.
Okay.
So this is this is an example of a contract specification. We'll probably stay on this particular contract and the examples for today. And so this is a Ether Bitcoin quarterly futures contract. So we have our root, which is the first three characters, ETH, which is the currency code for Ether, the native token that rides on the Ethereum protocol. We will tell you the expiry date. Generally, it's the last Friday of the month, of the calendar month, so the 30th of June. And we do expiry at 12 UTC. Now, if you're not familiar with UTC, get familiar with it because you will be trading 24/7. And so time zones are annoying. So everyone in the cryptocurrency industry uses UTC. Essentially, this is 8 p.m. Hong Kong time. N is our month code for June. Don't ask me why it's M. That's just a standard in the financial services industry. That's where we come from. That's what we're using. And so to combine it all together, we have ETH M17. The 17 represents 2017. We will also tell you the underlying, which is the Ethereum, Bitcoin, Poloniex exchange rate. And then contract value. So each contract is worth 1 Ether, which keeps things very simple in terms of when I need to determine what my hedge should be. And I quote everything in Bitcoin terms. And I settle my margin and my P&L in Bitcoin terms. So it's very linear. Price goes up 1%, your P&L goes up 1%. Let me just show an example of that on the web here. So this is BitMEX Live. Let's show you another contract. Let's see here. So up above, we have a nice little We'll tell you exactly what it equals. We'll break down this symbol for you, where it's coming from, month, code, year. Have a little nice chart here. We'll tell you the settlement index. And then down here you get the contract details. Now, two very important things. One thing for a speculator is your initial margin and your maintenance margin. And this is telling you how much leverage we're giving you. So 1 divided by this number gives you how much is the maximum leverage you can use when trading this contract. This is also very important. This is your liquidation level, where we will basically close out your position. Now, unlike traditional trading platforms, we don't phone you up and say, hey, in 8 hours' time, can you please deposit some more Bitcoin so you don't get liquidated? We liquidate you immediately, and you lose the entire maintenance margin. Now, if you are trading strategies where your profit margin is in less than in the basis points, or even maybe in the hundreds of basis points, you cannot afford to lose 100% of your, 50% of your equity because you did not monitor your liquidation prices correctly. So in arbitrage strategies, you definitely need to be monitoring where your liquidation price is and making sure that you never reach that point, because it will blow up the profitability of your trade. All right. So the strategies that I'm going to be talking about today are essentially interest rate strategies. What we are trading here are interest rates. The altcoin that we're trading is almost irrelevant. All we care about is how much interest am I getting paid for lending and borrowing the relevant currencies. Now, because a futures contract has a fixed expiry date, the basis represents a fixed interest payment from longs to shorts or shorts to longs, depending on whether or not the future is trading at a premium or discount. So I will talk about the percentage basis outright. This is basis divided by spot price. My time value is the number of days between now and settlement divided by 365. And then my annualized basis. So if I'm comparing two different strategies that have two different expiry dates, I need to look at the annualized rate of return I'm getting for putting on those different strategies to evaluate where I'm going to place my capital. So very important to understand that basis is a fixed interest rate payment or receipt. And so this stems from the identities that I talked about earlier. That when basis is positive, meaning if I short the contract, I'm essentially lending and I'm earning a rate because I'm selling something more expensive. On the other hand, if the futures contract is in backwardation and I'm buying the future cheaper than spot, as a long holder, I'm getting paid and the shorts are paying. So here is a very simple example about interest rates. So assume that my futures contract is trading at a premium and I go long that futures contract. And let's assume that the underlying spot price doesn't move. The identity tells me that the futures price will decay to the spot price, so I've essentially paid a unit of 1 to get long exposure, and the price didn't move, so essentially my trade cost me 10% to get long this exposure. Now, why do people pay these rates? So there's the market is bifurcated into two types of traders. There you have your speculators, and they're willing to pay very expensive interest rates because a particular coin is extremely volatile. So they think that I can buy it at 10 today, and a few days' time it'll be 25. And they don't care if they pay what we would consider very expensive rates of interest to essentially borrow that long exposure from the short person. Now, on any of these arbitrage strategies, they are not leveraged, meaning if I sell 1,000 Ether contracts, I'm going to buy 1,000 physical Ether. So essentially, I am using no leverage, and I'm essentially lending my capital to the speculators to get that exposure. And I'm getting compensated for that in the form of a basis. And so this is a similar example taken from the other side, where the shorts are paying interest. So the first strategy that I'll talk about today is cash and carry arbitrage. And this is probably one of the simplest and most effective ways to increase your stack of Bitcoin using altcoin futures contracts. So if my futures price is greater than my fair price, I'll talk about fair price in a moment, meaning my basis is positive. I will be selling futures contracts and buying the underlying spot. If, this is a typo, should be less than fair price, I will buy future and short spot. And in both cases, I'm going to earn a fixed rate of return for providing my capital to the market. And then the most important part of this is I need to hold this trade until expiry to realize this anticipated profit that I forecast a priori before I put on this trade. Now you can day trade the basis, saying, okay, I'll sell in basis at a 40% annualized. I'll buy it back at plus 20, so I've made that spread, then I'll go back into the trade when it gets higher. That's a little bit more advanced. If you just put it on, forget about it, you need to hold the trade until the futures contract expires.
So about the settlement price, so how do you determine the settlement price? Is it exactly the moment of the expiry, or it kind of?
So for the altcoin contracts, we use a 30-minute time-weighted average price. So from 11:31 to 12 UTC, every minute we'll look at what is the spot price, and they'll do a simple average of that. And so technically speaking, if you want to exactly match settlement, you get an algo or you manually do it, and every minute you close your underlying spot position. Okay, what is fair price? This is a very important concept as well. So every one of you will have a different fair price for a futures contract, because every one of you will be able to borrow and lend the currencies at different rates. Every one of you has a different internal benchmark as to how much money you need to earn before you will venture out and put on any of these trades. So as a trader, where can you borrow and lend Bitcoin? Where can you borrow and lend the underlying altcoin? That is what helps you determine what your fair price is. The theoretical, I guess, Finance 101 is covered interest rate parity. And that assumes that if in no arbitrage situation, the differential in interest rates between my home and foreign currency will determine where the futures price should trade. Now obviously we live in the real world, and that is never the case. The market is inefficient by definition. That's why you're all here. So you can do this sample calculation, but essentially this is something that you want to use as a benchmark to give you, should I put this trade on or not? Now your actual P&L might vary from this fair price, but it's a good way to start evaluating which trades will be profitable for you. The lending market. So as I said, Bitcoin and your relevant altcoins have a borrow value, and traders are willing to pay other traders for inventory. So if I want to short Bitcoin, I need to borrow it from somewhere and sell it on the market. If I want to short an altcoin, I need to borrow that as well from someone and short it on the market. Now Poloniex operates a P2P lending market where people who have Bitcoin, people who have different altcoins can interact on a market and lend out their collateral to other traders to short. So when you trade on margin, you're effectively interfacing with this P2P borrowing market to get your collateral that you want to short sell in the market.
I didn't see a section in your website where you can lend altcoins to others.
We don't offer this feature. So this is, the borrow market is on Poloniex,
Okay.
and the borrow market is something that we look to as an objective measure as to where the futures price should be, where the futures contract should trade. Because essentially what a futures contract represents is a difference in borrow value between two forms of collateral represented in a currency pair.
Is Poloniex also where you get your interest rates for borrowing BTC, that type of thing?
Yes, so when I go through an example in a minute, if you want to, I guess, get your opportunity cost of capital, you will look to, okay, if I just stuck my coins on Poloniex, I would get X% per day. So if I'm going to put on this futures versus spot arbitrage trade, I better earn at least that. Or else, why would I go through all the hassle?
Do you guys mark up the interest rates? Or?
The interest rate, the implied interest rate in the futures basis is purely a function of the market.
Okay.
And because we offer more leverage than Poloniex, it will trade at higher or lower levels because traders can, go into and out of the market with bigger positions. And that is what gives you the opportunity to earn a return on your capital because you're essentially lending them the exposure to go the other direction. So if the market's pumping, why would I sell into this market if, say Ripple is rocketing upwards and upwards? Why would I provide short exposure to a long holder at 20x leverage? Because I'm getting paid an obscene amount of basis because the future's here, my spot price is down here. Now maybe I can only earn this much basis if I put my Bitcoin onto Poloniex. So essentially, every trade that I'm going to talk about today comes from the fact that the BitMEX futures market is inefficient and the basis does not represent the borrow market, the actual collateral borrow value as evidenced on Poloniex and other platforms. That is what you've arbitraged.
So the interest rate that we see on the website, because you have to pay interest or receive interest every 8 hours, right?
So that's a different product. That's a total return perpetual swap. So I'm not talking about that particular product today. I'm talking about a fixed expiry futures contract where you essentially are paying a fixed rate of interest to get your exposure, paying or receiving a fixed rate of interest to get your leverage exposure.
Which is simply determined by the market price.
Exactly.
So it's not really the interest rate is the consequence of the causality lies with the buying and selling of the
Yes, it lies with I think this coin's going to the moon. I don't care if I'm paying 100% per annum to get long this 20x leverage futures contract. You as a market neutral arbitrager say that's great. I'm earning 100% return per annum on my Bitcoin. I'm just going to sit here in my wallet. I don't have a particular view, nor do I want to day trade this coin, right? So I'm just going to provide that leverage to the market, earn my rate of return, and happy days. So both people are happy. Speculator gets the exposure they want. Arbitrager gets a fixed rate of return on their capital, over and above what they would get on other platforms.
My question is like, how about one side got defaulted?
So we do have a method, what we call auto deleveraging. And so what that means is at BitMEX, it's limited liability. So if I'm a speculator and I go long 20x and I go bankrupt or I get liquidated, I can't ever owe BitMEX money. So unlike your FX broker for, maybe, I don't know, FXCM or Saxo Trade, they do have a clause in the contract saying, if you go into negative equity, we can sue you and we can go after your personal assets replacing these trades. Now, in Bitcoin, we don't do that, nor can we do that. So what that means is the amount of money that's in the system in terms of the margin allocated globally for a particular contract is the total amount of money that can be used to pay out a long or short holder of the contract. So in the situation where the market rallies or falls quicker than we're able to liquidate someone's position or close them out, we will early assign the other side of the trade, meaning we will close you out early in profit so you will lose your exposure. Now obviously if you're putting on hedged trades, this can prevent a problem.
This is auto
deleveraging. So we do provide real-time updates as to if this has happened to you. We give you email updates.
Is it formula-based?
Yes, so you can look up the exact mechanics of this on the website. But I would say that for the altcoins in particular, because we have very healthy maintenance margins, meaning 2%, 2.5%, say in the case of I think I just showed you dash. That means that we have more than enough equity from the party that got liquidated to close them out in the market. And so we have very few occasions where we have to early assign someone's position. But yes, you're correct. That is a risk of putting on these trades. All right, so let's go to the spreadsheet.
So even if you have a covered position, a hedged position, there is still this risk that on the future side you might be liquidated, and hence
Well,
you
there's two risks. I'll go over your risk of liquidation, meaning you didn't put enough capital behind your trade. That's definitely a risk, and the market goes against you. You have an unrealized loss that crosses your liquidation point, and then you are liquidated, and you're left one-sided. Or you are in a profit, and the market is going aggressively in one direction, and your profit is cut short because there isn't enough money on the other side to pay you out. And us as BitMEX, we don't guarantee the settlement of trades because we offer high leverage. We use this auto-deleveraging feature to essentially assign that risk to the pool of P2P participants. So it's a pure P2P product, which is different than a futures exchange you may have traded on, like HKEX or something like that, in the more traditional financial field. So let's go over a simple cash and carry example. So here we have our Ethereum quarterly future versus the Ethereum spot. And these are the due prices, and we have a basis. And number of days of expiry, say I have a month left, and I've just put in two different borrow rates for Bitcoin and Ether. We can calculate a rough fair price. So should I put this trade on? Being short futures, long cash? Yes, I have a positive fair basis. Okay, so next step, let me actually go into the mechanics of putting on this trade. So what am I going to do? I'm going to sell 1,000 quarterly Ether contracts, and then I'm going to buy 1,000 physical Ether. So very simple mechanics, and the fact that each contract is worth 1 unit of the altcoin makes determining the size of your hedge very simple. Now let's go to settlement. Again, at settlement, futures price always equals the spot price. Now let's go through our profit and loss statement. So on our futures contract, we can look at our profit and loss. We had 1,000 contracts. Initially we entered at that price, we entered at that price, and there's our Bitcoin P&L. On the spot side, we were long 1,000 units, entered here, exited here. There's our realized Bitcoin profit there. This is very important here. So I actually bought physical Ether on Poloniex. And as we said, this Ether has value. People are willing to borrow it to short it. So what do I do between now and when it expires? I take my 1,000 Ether and I lend it out at 10 basis points a day, or 0.1% on Poloniex, and I earn income as well on that collateral. And so our Ether FX at a rate gives us that much P&L. Now down here we have our Bitcoin opportunity cost. Now instead of doing all this, I could have taken my 40 Bitcoin and said, hey, I'm just going to lend it out of Poloniex and make this rate. So I could have made 6 Bitcoin by doing practically nothing. So how much did I make excluding my opportunity costs? This is an accounting profit, right? I made 5.8 Bitcoin. My actual cash flow statement, I've made 11.8 Bitcoin. So this is a very simple stylization of the trade that you can do. Now, you can do this manually, meaning you can open a browser with Poloniex, open a browser with BitMEX. Okay, the rate looks good. Sell here, buy here, and put on this trade. Now, if you are constantly looking for opportunities on where to enter and exit the market, you will want to build this programmatically so that when you sell in BitMEX, you automatically go and start buying on Poloniex and make your cash and carry trade.
So how to define the daily rate?
The daily rate will be on, you'll get that from Poloniex. Now this isn't a fixed rate, so I'm not, in actual life, I'm not guaranteed to get 10 basis points per day on my collateral. It's very tough to essentially term out your capital. Usually the longest that people can actually get is 2 to 5 days. So these rates are fluctuating. So this is a variable rate. However, you're putting your trade on as a fixed interest rate. So you know exactly how much money you're going to make when you put this trade on initially. So this 50 basis points per day on Bitcoin,
Why
that
is it
could
so
go down.
high? Why is it so high?
This is just an example. But
Okay.
But in general, in reality, what happens is, let's say that a particular coin or the whole altcoin complex is rising, which it has done this year. I mean, Bitcoin, in terms of percentage market
So
share,
people borrowing.
right? People are borrowing Bitcoin to buy altcoin because the altcoins are ripping, right? So they're willing to pay extremely high rates of interest per day
I see.
on Bitcoin to get that long leverage, long exposure, and so that'll feed into the futures contract. So at a minimum, the futures contract on the upside should be trading at that premium. But because we offer more leverage, it's going to trade even higher. And that's when you can come in and put on these basis trades. But as I said, this 50 basis points, or whatever the rate is not fixed in stone.
It's dynamic.
Now one thing I want to show here.
Do you have a historical borrow curve for the?
You can. I'm sure if you look on the internet, you can find someone who has the Poloniex data, who script the Poloniex data, and you can get historical lending rates for that data. Or you might even be able to get it from the API. I'm not exactly sure. So they do have historical API calls, and I think you might be able to get historical borrowing and lending rates.
So if I cut all my position before the cut off the time at 8 p.m. Hong Kong time, do I need to pay any interest
To who?
to the other side of the trade?
So there's no interest payment that you're paying to BitMEX. This is all implicit in the basis. So essentially, it's a payment between the long and the short. We take no part in that. All we do is charge you a trading fee, both sides, a trading fee to enter and exit the position. So when I talk about interest, this isn't BitMEX determining a rate and charging you. This is the market says that the basis is $100, and so that's going to represent a payment to one party and a receipt of payment to the other.
Yeah, that part I know. But what I'm saying is if I square all my position and put it to 0 before the cut-off time, so there is no counterparty on the other side of my trade because I have no trade.
Right.
That means I don't have to pay anything to the other counterparty.
Well, you've essentially, the futures contract will decay to spot. So theoretically, every second that you hold that futures contract, you're either paying or receiving a rate of interest,
Okay.
what you call theta. So you have theta. All these trades that I'll describe are positive theta, meaning you earn carry every day. And the other side of the trade who's speculating has negative theta, but they're going to make it up in delta, i.e. the difference in the price of where they bought it and sold it as a speculator with leverage.
Okay.
So one thing I want to illustrate here is, remember that our BitMEX P&L is in Bitcoin, and we bought Ether. So we're short futures contract, and we hold physical Ether. Now, BitMEX does not take other collateral besides Bitcoin. So even if the market rallies 100%, you can't come and say, hey, Arthur, I've got 1,000 Ether. I'm good, right? Like, I'm not going to get liquidated on my futures contract. I'll say, well, no, the futures contract unrealized P&L is in Bitcoin. So please give me some more Bitcoin. Now, obviously, this trade doesn't work if you go and liquidate your collateral, your hedge, and go give me Bitcoin to fund your unrealized losses. So as you see here, I've now got a negative 50 unrealized loss on my position. So in these trades, you actually don't want to use your entire portfolio of Bitcoin and have it termed out in these trades. Because if the market goes against you, against your futures contract position, you will need to deposit additional Bitcoin on BitMEX so that you are not margin called. It's a very important distinction. Some of the other seminars I've given, I've talked about our inverse futures contracts on Bitcoin US dollar, whereby if you have a one-to-one trade and give us the Bitcoin, you have no possibility of being liquidated. This is not the case. So it does require a little bit of portfolio collateral management to make sure that your liquidation price is never reached. And again, it's in Bitcoin, not in the altcoin.
Sorry, what do you mean with the word inverse? When you say inverse contract or something?
It's basically the style of contract saying our Bitcoin series, it's worth $1 of Bitcoin, or a 1 over x 10 to the minus 1 function. But it's not really relevant for this discussion. I'm just putting it in context for some people who've come to previous seminar that I've given where I've talked about strategies where you can't get liquidated when the price moves against you. This strategy is not the case. You definitely can get liquidated if the price moves against you, if you do not deposit more Bitcoin on BitMEX.
So can I say the real underlying is actually Bitcoin?
No, the underlying is a Bitcoin Ether exchange rate. Your collateral is in Bitcoin. Your margin is in Bitcoin. That is your unit of account is in Bitcoin. And you before we start all of this business, you are viewing yourself as a Bitcoin holder.
Because I'm thinking
You don't care about what the value.
like S&P future, I'm going to hedge with the, like, I don't know, with maybe
Right, you're going to sell it to underlying stocks, but
But
you
it pays
can't.
out in dollars.
Yeah.
So you wouldn't say your underlying is dollars, that's just the settlement currency. Same here, Bitcoin is the settlement currency.
Like you can't go to interactive brokers and say, here's 500 stocks, please don't liquidate me. CME say, nah, give me some US dollars. Same concept.
Okay.
Simple question. I'm not very familiar with Bitcoin. So once I deposit my Bitcoin into BitMEX, does the ownership transfer to BitMEX?
Yes, you now have an IOU. So we hold your collateral, and you can use that collateral to leverage up and buy our contracts. Once you've closed your position and realized your profit, then you can then withdraw your Bitcoin. But you are completely correct that once you've sent your Bitcoin to BitMEX, it is under our control, and it is our responsibility to safeguard your collateral. And the same is true for, let's say if you bought Ether on Poloniex and you decided to lend it out on Poloniex, you are taking counterparty risk with Poloniex because you are receiving a daily rate, but that Ether could get lost, could get hacked, could get stolen, all sorts of things. And so you are taking these counterparty risks. And that counterparty risk is part of the reason why the rate of return is so high for putting on these types of trades. Because who is willing to stick all the collateral on these two platforms? Only people who think they're going to make that and above in terms of profit.
Is the lending rate for altcoins also executed 3 times a day?
Well, for Poloniex, I think it's a daily rate. I'm not exactly
for
sure.
I mean for BitMEX.
No, there's no funding rate. So if you guys are used to trading our Bitcoin US dollar swap, which is an actual discrete payment or debit from your account every 8 hours, it's completely different. This is a futures contract. The interest that I am talking about that you receive is a function of the futures contract trading at a different price than the underlying spot market.
Talking about the counterparty risk when I sell a future or I buy a future, is my counterparty the exchange or is it another person trading?
So in terms of your financial risk, you are trading with the pool of other people in the market. So
with the pool.
Well, I mean,
My
it's a
counterparty
future
risk is with the pool.
Right, because as I said, this is auto-deleveraging. If someone gets liquidated and we can't close their position out in the market, then we have a way of early assigning people's contracts, their contracts, and closing them out early on profit. Meaning you do have a sort of a herd risk in terms of will my position get closed out early because someone went long or went short with a lot of leverage and got liquidated and the market couldn't handle their size. That's a financial risk. You also have a risk of your actual underlying equity collateral, and that's what I was speaking about previously, where we hold your Bitcoin on your behalf, and we use that as a way to margin your position. So you say, okay, I put up 1%, he put up 1%, we'll allow you to trade 100x. And so we have to safeguard that collateral. We have to move the profit and loss between the different accounts. That's what we do as an exchange. That's our role.
But he might be doing 25x, he might be doing 50x. That all goes into a pool, yeah?
Well, everyone trades, everyone puts up, everyone has to, at the minimum.
I mean, I'm not matched. If I do 25x, I'm not matched.
Yeah, you're not, it's not like,
with a pool from.
it's not like trader A, puts on an order, matches with trader B, and that is their contract. No, it's a pool.
Really a pool concept, irrespective of him doing 100x, him doing 25x.
So we set the maximum level, and people use leverage in between.
So effectively, everyone has the minimum maintenance margin requirement. So for Bitcoin US dollar, that's 0.5%. So it doesn't really matter how much they put up to start with. At all times, everyone's got 0.5% of equity maintenance margin backing their position. And if they get liquidated, that 0.5% is normally enough to close out their position. So you might be long, someone's short holder gets liquidated, that 0.5% is used to basically buy their position off someone else who goes short. So there's a new total counterparty. But you as a trader don't really need to worry too much about that process, as long as it's operating
Continuous.
Yeah, so it's continuous and smooth.
With the auto deleveraging, everyone gets.
No, so we have a ranking system based on your effective leverage and how much profit you've made.
Oh, okay.
Yeah, so there's a
So
document
guys
that
who've
goes.
made hold positions with the most profit, they get.
We have a somewhat of a indicator as well, but if you go on the reference section in BitMEX, there's a document and it explains in great detail exactly how that process is done.
Yeah.
So I definitely, if you're going to put on these strategies, I would suggest that you familiarize yourself with that document.
Talking about the liquidation rules that you mentioned previously, when, let's say if I did a trade and it has been making money and the market is going along with me and I keep on making money, but still I have the chance that my exposure will be liquidated because the other side of my trade was liquidated. Right?
So let's be very clear with the terms here. If you're in profit, you are not getting liquidated. You are getting closed out early in profit. So you do not lose your maintenance margin. Now, when you get liquidated, that means that you are losing money, and we say, okay, you put up a minimum amount of equity. We're going to take that and use that as margin to close your
I will
position.
be basically cutting off my position.
Correct.
Profits.
Yes.
Much earlier on. But why don't you automatically match me with another counterparty at that time so that I carry on longing doing my exposure?
So that's something that we're looking at possibly offering. The one caveat to that is, how do you determine what's an acceptable market slippage that you'll be willing to take? So no, we need to come up with a system.
Choose and mention it in the system.
Yeah, so I mean that's one variable is, yes, we could automatically re-enter you into the market, but we want to automatically re-enter you 5% higher? Are you willing to take that, or do you want to say, okay, I want to limit it to
Let's say
this
if
amount?
I put on, if I write like allow me to accept the 5% slippage, then you put me on.
Yeah, so that's definitely something that we are looking at incorporating into when someone is leveraged, automatically adding them back into the market, subject to some sort of limit.
Although, of course, the problem with this scenario is, let's say you're long, you're in profit, market's going up, some short holder is liquidated. We then try and close out that short position with a bid in the market, so we're buying to close a short. An ADL, automatic deleveraging of your position, only occurs if this liquidation isn't filled. So what does that tell you? It tells you there aren't enough sellers, there aren't enough offers to be reached. So we close out your long. If you wish to then rebuy, to re-go long, well, there aren't sellers in the market. There's normally a very, in this situation, normally it's a wide spread, or the market has gapped. So we have to be very careful about if we offered this feature and actually making people understand that it's going to cost them some slippage, and it may not even work.
That's totally understood. But also, from my understanding, there's no transparency on the other side, like my counterparty. So I really cannot tell that, like, when my trade will possibly be closed.
We do offer a sort of ranking system, and we'll tell you if you're likely to be deleveraged if an event happened. And again, that's gone into in detail in the document on the reference section. So it'll tell you, and there's a little light section. So these bars here are an indication of shows your position in the auto deleveraging queue. Now, how we determine your position, again, that is located in this handy little guide called the Alternate Deleveraging document. And this reference section is amazing because I wrote it and with the help of some of the other BitMEX staff. But we are probably one of the only exchanges that will tell you in very clear details exactly how every facet works. And so I would encourage everyone to read this information. Okay, so we went through a cash and carry example. So the next strategy basically hinges from the fact that in the Bitcoin ecosystem, a lot of people are haters, and the hater rate is very strong. And which means that any new altcoin, no matter how amazing it sounds, or how cool the team is, or how high the price has gone, people want to short it to zero, and they think it's worth nothing, less than nothing. And so they're always looking for a way to short altcoins. And it's usually very difficult, because one of the biggest reasons why these things pump is because the supply is restricted. Either the development team pre-mined the majority of the float and only issues a small fraction, or they get all their buddies to buy it up, and there's very little left for actual secondary market trading outside of large holders who refuse to lend it out to others. So one of the best ways to get short exposure on many altcoins is through BitMEX, because we offer your aggressive leverage on the short side as well. Now, as we've been talking about, these altcoins have a borrow value, and that borrow value at some times is very, very high. And so what we want to do in a proactive way is to create inventory in an altcoin without exposing our portfolio to any price risk on that particular coin. And when the situation arises that the market is, say, entering free fall and people are willing to pay obscene amounts of interest to borrow a particular altcoin, we stand ready with inventory to lend to the market at a rate of return. And so that's what I mean here by harnessing altcoin repo or borrow value, is to proactively create inventory in altcoins so that you can respond to dislocations in the market.
So you're saying that the exchange is an actor in the exchange as well?
No, I'm saying that the market mechanics of altcoins usually lends itself to a very small free float of trading, which usually means it's very tough to short it.
Right. But you will buy them.
So the strategy that I will talk about, what I call create to lend, means that I'm going to put on a derivatives play for the sole purpose of creating inventory in a particular altcoin without having any exposure to the price. Because why would I just buying a coin and say, hey, I'm going to lend it to the market, and the coin drops 50%? That's stupid. I'm just going to lose money. Now, using BitMEX futures contracts and buying the underlying coin, I can create a hedged position in Bitcoin terms, and now I have physical altcoin inventory that I can provide to the market when the price is falling a lot, or when just people are willing to pay a lot of money for that borrow. And that's the point. So create to lend and cash and carry are very similar strategies. What I will be doing is selling the futures contract and buying the underlying spot. And now because this underlying spot is free, I can then lend it out at a rate of return. Now, this also hinges on another dislocation in the market. So if my altcoin is worth a lot of money and a borrow rate, technically speaking, the futures contract should be trading at a massive discount. So usually what you want to do is you want to create inventory when the basis is positive or flat. Because when the basis is negative, that means that the futures contract reflects the fact that it is extremely hard to short this coin because it is extremely expensive to borrow it. Therefore, the futures contract trades at a massive discount to its underlying spot price. And that is a wrong time to put on this strategy because you are locking yourself into a negative carry position to create inventory in a fixed rate, and now you need to bet that you're going to make more money lending out that coin over the life of the futures contract than the fixed loss that you've locked in between now and the expiry. So when a coin or a futures contract is trading expensive to spot or at the spot price, you should be creating inventory, ready to respond to the market. This is a very simple example. So we're going to talk about the Ethereum again contract, and let's just say that the contract is trading on a flat basis. No premium, no discount. 30 days to expiring, and it costs me 0.1% to borrow the Bitcoin, and the Ethereum borrow rate is blown out to 1% per day. And so I'm going to create inventory again by selling futures contracts and buying spot. Now, just purely looking at the interest rates, my creation cost is 0%. That's because my basis is 0. So the creation cost and the percentage basis are the same thing. The borrow value of my Ether, 30 days times 1%. Now, obviously, I'm making the assumption that I can get 1% per day for 30 days. Obviously, that's not the case. And then my opportunity cost of Bitcoin. Remember, I had to take physical Bitcoin to buy this Ethereum. I had to take physical Bitcoin to BitMEX as margin on my futures position. So that has a cost, and that cost is what could I earn by just lending out my Bitcoin. So if I take subtract, I come with my lending P&L of 27% for this 30 days. So essentially, this futures contract is mispriced. This futures contract should be trading at a massive discount. Now, why wouldn't that happen? Because while you have people that think every coin is worth less than 0, you have everyone who thinks that they're going to be buying a yacht tomorrow because they bought XYZ altcoin. And they don't care. They're willing to pump it and keep buying it just because they believe in the founder, they believe in the team, they believe in the tech, what have you. So they might be willing to go long at leverage and have more desire and keep the futures contract elevated, which is perfect for you because now you've opened up an arbitrage opportunity to create inventory and lend it out to the market. So, as I was saying before, you need to keep an eye on your liquidation price and how much Bitcoin you need to make sure that you never hit that price. Because depending on how the market moves, you don't want to ever be out of hedge. These strategies are meant not to have any price risk on a particular altcoin. All right, so let's just look at some market opportunities right now on BitMEX. So, on our advanced view, we have a instrument table. And this gives us here's what we're looking for. We're looking for the fair basis rate. And this is where approximation of where the market is trading. for a particular coin. Now, we are looking, depending on our portfolio, let's say that we're looking to short future and buy spot, we're looking for coins that have a positive fair basis rate. So that's what looks interesting. So Dash looks 64%. These are all annualized numbers. So you'll have to take the time value, multiply by this rate to get your outright earnings, putting on these strategies. Now, these are more serve as a guide. So if I wake up in the morning, I load up BitMEX, okay, what am I going to arbitrage today? Come to this table, look down the list, see, okay, that looks attractive. And then I'm going to actually go to the actual market and see what the liquidity is like, see what the bid side is like. Can I actually put on size at this particular level and put my arbitrage trade together? But this is sort of a good guide as to where you should be focusing. And obviously all this is available via the API. And as you get more sophisticated, you should be consuming the API data, and you will have a matrix of what is attractive, where you should be placing your capital to arbitrage. Especially if you're going to be going in and out. When the basis is high, you're selling, when it's low, you're buying. And you're just doing that all day long. And you don't care what the actual price of the altcoin is.
Where do I find this thing?
So, I'm going to tell you, usually when you sign up for an account at BitMEX, you're going to have the basic, and there's no instrument table. So what you'll do is on the upper right-hand corner, you see this little busy grid. You click on that. And now you've gone to the advanced view. Now our CTO is a badass, and he's made these really cool customizable widgets, and I can move the size like this, and create my own little trading interface. Super cool. And so I go down to the bottom to what we call the instruments panel. You maximize this, and then I'm going to scroll to the right near the end. And there I am, fair basis.
So all this information is being pumped over the API and the WebSocket. We don't actually expect people to be looking at this table on the front end. It's just we do have all this data, so we make it available.
Yeah, so if you're building your own trading bot or strategy, you can compute this yourself. You can consume this data straight from the API streaming to you. You don't have to actually look at this visualization. But if you just want to eyeball things, this is a good place to go. All right, so I'm going to end with a little ICO. This is probably the hottest thing that's going on right now in the cryptocurrency industry. So what is an ICO? Initial coin offering. I'm sure most of you are familiar with an IPO. A team is willing to sell equity to the public at a price in a public gala, essentially. So an ICO is a team. They usually have a piece of proposed tech, something they will do in the future, and they say, hey guys, I need some money. Why don't you send me some Bitcoin and some Ether to this address, and sometime in the future I'll give you some tokens that you need to use my application. The theory is, the more that my application is useful, the more people use it, the more people use this token, i.e. it has value. Now, 99% of the time, that's complete horseshit. They are dog shit, and they're worth zero. But that doesn't mean you can't make a lot of money trading them. So what is the timeline? So usually a website will pop up saying, Arthur Hayes Coin is doing an ICO. Please give your Bitcoin and Ether to this address, and here is the conversion rate. Say 1 Bitcoin to 10,000 Arthur coins. And in 6 months' time, I'm going to have this awesome application, and I'm going to deliver all the Arthur coins to the market. So once I've delivered my Bitcoin, I need to wait a period before those tokens are delivered. Now sometimes this is an immediate distribution. Sometimes it takes months, maybe even years, to get these tokens. Because again, you're investing in a project, and most likely they've not done a single thing other than hire a marketing and PR term and legal advisor to put up a website. And you're giving them millions of dollars. Pretty crazy. So in a period of time, the token begins trading on the secondary market. Now, where do we come in as BitMEX? So, there you have ICO distribution, you have secondary market, and you have all this time in between where what is this thing worth? The team's putting out different developments, they're telling people, hey, we've done this, the timeline's this, I think we're going to be done a little early, I think we're going to be done a little later, and that'll affect the market sentiment on the viability of this particular project. What we do at BitMEX is we're committed to providing price discovery on these ICOs before they list on the secondary market, so that people can know what is the market think this coin is actually worth based on what's going on with the team. And so what we offer are leveraged futures contracts denominated in Bitcoin on the future price of an ICO when it lists on the secondary market. Now, our two most famous examples are Zcash and Gnosis. So Zcash it's launched right now. Zero cash, it's basically anonymous transactions for electronic money. And very similar to Bitcoin, except that everything's anonymous. And so what we did was, this is like the biggest hype project of 2016. We said, okay, right, we're going to offer a futures contract on Zcash before the Genesis block, meaning before it starts being mined and distributed into the market. And so Zcash went from about, I think, $30 to a few $1,000s, so up thousands of % on our particular futures contract before the thing even listed. Gnosis, something similar. Gnosis, the ICO happened, I think, last month. It was the most valuable crowdfunded project in human history as of the ICO price. So they raised $12.5 million US at a $300 million US valuation in under 10 minutes. And so what did we do? About 12 hours later, we listed a futures contract on what would the price of Gnosis be in 1 week when it listed on the secondary market. That particular ICO went up, I think, 5x in a week. So, we're giving people the ability to go long and go short these ICOs. So,
at what time, you issue these contracts at the time that the ICO has happened?
Sometimes before it has even happened.
Or before, even before?
Yes. So it's literally...
But what then happens if it's not going to go ahead?
Goes to zero.
Okay.
So one use case for ICO derivatives, you subscribe for an ICO, you get an allocation, and you see, oh, the BitMEX ICO price is rocketing higher. Let me lock in some profit now on what I will receive in the future. So I will receive ICO at date X. I'll sell BitMEX ICO. I've locked in this profit in Bitcoin. And so now, regardless of where the ICO price opens, even if it doesn't open at all, if the team never materializes, I have made that difference, and so I've locked in a gain on my ICO. What a lot of people use these for? To go long an ICO. Now, the whole goal of this whole ICO process is to engineer scarcity and fear of missing out from people so that they give their money faster. So that usually means a hot ICO will be sold out within minutes. So if your job is not to watch the cryptocurrency markets 24/7, there's a likely case that you will not get any allocation of this deal, and you'll be forced to buy it on the secondary market. And as you've seen in some of the BitMEX ICO derivatives, that secondary market price pops pretty aggressively if it's a hot deal. So you want to get in before that happens, obviously. So that's why a lot of people will, as soon as we list an ICO derivative on BitMEX, they will start going long to get that financial exposure to the ICO they were unable to get because they missed or they did not get an allocation in the particular issue. And the best part about this, you get leverage and it's in Bitcoin. So you never have to touch the ICO itself.
How much notice do you give before you add a new ICO product to BitMEX?
It could be weeks, it could be hours. It really depends on how hot it is.
Like email? Or
It'll just appear, and then people start tweeting about it and talking about it.
I mean, we do send out an announcement that we could make a decision and build the index and launch the product in 2 hours, and we have done, just because we think it's a good idea. So we'll let you know.
But you might find out faster if you're just watching Twitter, because we'll send an email usually afterwards that hey, trading is open. You can start trading.
It's like the regular exchange. They have a like very strict rule like for like IPO. I mean, do you have like also kind of stricter rules?
So we're not
for
we're
ICO?
not a place where you can actually buy physical ICOs. This is purely a speculation on a price.
So you offer speculation. You
Right.
offer
So
the
we're not
issue.
saying this is a good deal. We're saying this deal is either worth infinity or nothing. Take your pick. We don't care. We're agnostic. We're just going to allow the market to price what the future value of this ICO could be.
So Twitter is going to be the first place to hear that
It
you're
could be. I
having
mean,
new
it depends
instruments.
on. So, like, take for example, there's a deal called Tezos. I've gone on record saying I think this is going to be the largest crowdfunding project in human history. So last year we had the DAO, which raised 150 million US dollars in a month. I think that they'll surpass that in 2 weeks, in this June.
And
And I've gone into reasons why on my blog. You can read it and figure it and see the reasons why I think it's going to be bigger than that. But we've already basically told the market that as soon as the ICO ends, we're going to launch a derivative on Tezos to expire at the end of the year when it is expected that the distribution of Tezos, as they call them, will hit the market. So if we think the deal is hot, we will be out there on our megaphone, i.e. our blog, telling people, hey, this is something we think is going to be cool. It could be worth zero. It could be an Ethereum, 23,000% in 4 years. I don't know. It's not really our job to judge. All we want to care about is getting that price discovery, giving people the opportunity to go short or to go long.
But
So
do
this
you
will be the
choose-
third ICO. Yeah, because you've done 2 already. This will be number 3.
Yes, we have.
Gnosis and
ECC win.
We've done 3 actually. We did another one called ETC Win, which is a project based out of China. But I'll go over in a second the 3 projects that are on my radar of things that I think will foster a healthy market.
Do you choose like which quant to be listed in your exchange?
Well, we choose, basically it's based on customer demand. So if no traders are talking about it, then obviously it's not hot. So why would I put a derivative on it? Because it's just going to sit there and collect dust, and no one's going to trade it, and then it just looks bad. We don't want empty order books. If you believe ICO equals shitcoin, then you can short a particular ICO. And the best part about shorting it is, aka you don't have to borrow the ICO, and the ICO might not even exist yet, and you can still go short it. And so you can go with leverage, and again you get Bitcoin, and again you can exit at any time. So if I subscribe for an ICO, I can't exit until the secondary market starts trading. But with BitMEX, I can enter and exit whenever I feel like because it's an open market.
as long as there's a counterpart.
Exactly.
Was Gnosis available to be shorted on any other markets?
No. I think we still are the only place where you can short Gnosis.
Wow. How do you do that?
Well, there's someone who's willing to buy it.
Hmm.
It's a P2P transaction. There's someone who believes in it. There's
Just
someone
do the matching, right?
yeah, we're matching. We do order matching.
So in your previous 2 examples, so how was the liquidity?
Zcash was very good. So nearing when the actual Genesis block was, we were doing a few thousand Bitcoin worth of Zcash contracts per day. That has to probably be one of the craziest price actions I've ever seen in my life. The opening of that particular contract. When it opened, it went up to 10 Bitcoin. 1 Zcash for 10 Bitcoin on BitMEX. It opened on Poloniex at 1 Zcash for 3,300 Bitcoin.
3.
Yeah, and then it crashed 99.99% over the next few weeks. So it was one of the most epic just spikes and drops that I've ever seen.
I mean, when in the ICO process, right? When the quant, I mean, it needs to be traded somewhere, right? So where do they normally initially trade it then?
So there's other exchanges like Poloniex, Kraken, GDAX. They're all on the lookout for new things to add. And so you as a project will say, hey, exchange, I'm creating this token. Will you guys? And here's my wallet. Here's how my wallet works. Maybe I'm basing it on Ethereum, so it's very easy. Can you integrate this coin into your offering and let your customers buy and sell it on a spot basis? And so obviously the exchanges have to evaluate, okay, is this coin going to be popular? Am I going to get enough volume out of it? And so they'll make a determination on whether or not they'll accept a particular coin on the secondary market.
I see.
And usually we as BitMEX, we're trying to prevent as much manipulation as we can, so we usually will only consider a price valid for the settlement of a newly issued ICO if that team is able to get their coin listed on one of the top exchanges, because they're going to have more stringent listing requirements because they don't want to list a bunch of scam coins on their website. So upcoming ICO futures contracts, I spoke about Tezos. Another project that is pretty cool is Cosmos, and then Qtum coming out of Singapore and China. Very key phrase here, most likely. So it could be the situation where we decide not to list these, but these are some of the more talked about projects going on right now in the marketplace, and where we think we can generate enough two-way flow for a healthy market for people. So that is the end of my prepared remarks. If anyone has any questions, happy to take them.
Well, I have a general question, actually, a bit sensitive maybe. If we take BitMEX, it's a closed system, right? It's not like the futures market on the CME or anything. It's a closed system. So
What do you mean by closed system?
well, it's relatively small, and you have your players, your participants, and that's it. Yeah. Whereas with the CME, I could go to my broker and I could say, okay, I want to buy 10 futures of this contract. He will execute it in the market.
But
So
the CME is the market.
yeah, yeah. What I'm getting at is that, you know, in fiat currencies, you've got the market, international, it's very deep, whereas here, your market is not so deep. So you were talking, you talked about manipulation. I mean, it would be rather easy for someone like you, or you, to manipulate that market here in
I would answer that two ways. So firstly, we've done over $2 billion of turnover last month. So it's not a small market, it's the largest Bitcoin exchange in the world. That's a lot of turnover.
Yeah, and as I said, it's a sensitive
when you talk about
question.
manipulation, someone can manipulate the price on BitMEX, but that doesn't actually get them anything because of the nature of how we calculate the market price, and the market price is used to calculate unrealized P&L and hence trigger liquidations. We don't use the last traded price on our own market. We reference the spot market, you know, we reference the index. So to try and manipulate the BitMEX market, you have to manipulate the entire Bitcoin market or the altcoin market. So
Because some altcoin markets are rather small, yeah?
Yeah, I mean but that's the reason why we're all here. If this was a large, liquid, would you guys show up at 7 o'clock on a Wednesday to hear me talk about S&P arbitrage? No way. You're here because this is illiquid. You're here because this is new. You're here because there is risk, right? You don't earn 50% annualized returns trading HSI, short HSI versus long basket. I did this my whole career. You earn like 2 basis points after stamp. So there's a reason why it's riskier, and it's due to some of the factors that you have alluded to. Why doesn't Citadel, Virtu, you know, Getco, why aren't they doing these strategies? Because it's illiquid, it's, you know, relatively not as regulated as the other markets, and there's fears of manipulation, exchanges get hacked, all sorts of things happen, right? But for people who are, you know, single traders with a small firm with, you know, a few $1 million, a few $100,000, a few $1,000 of capital, these strategies are a great way to earn a risk-adjusted, very healthy return on your money.
Yeah, I agree with that, but then the same thing goes even more for you, because you have access to all the information, you know all the positions of everyone, right?
Right, but so does the CME. So does
It's not an
so does
isolated
ICE.
exchange.
And I mean, if we want to grow to be the CME, or bigger than the CME in terms of volume, using cryptocurrency industry, how short-sighted would it be for us to aggressively manipulate our market to make a few extra $1,000? We're not in this to make a few $1,000 and, you know, get a few extra $1 million of flow on our platform. You know, we want to be a big boy exchange, and the exchange operator can't be fucking around in the back end. Do that, and as you as a trader need to look at me and say, okay, is this guy full of shit or not? Should I put my money on his exchange? Do I think he is long-term greedy or short-term greedy? And I'll tell you, we were very long-term greedy at BitMEX.
Yeah.
Yeah, sorry, I just want to follow up on that. So that confirms that you guys are trading on your own exchange?
No. What I mean is we're not in that back end manipulate people's position and, hey, I got some money over here, I'm going to go and buy and then move the price up and down and in the back end to liquidate people. No, we're not doing that. We purely are an order book exchange. We give you this nice UI, we operate the margin, we custody your collateral, and we make sure that everyone gets paid out accordingly. We are not a hedge fund.
And to clarify, neither BitMEX nor its employees are allowed to trade on bitmex.com, but they are required to trade on testnet.bitmex.com. So our customer support representatives have to use the product, even though it's just testnet coin, fake money.
But your employees are not allowed to trade on BitMEX. Is that what you're saying?
Correct. Because, as you say, there would be a conflict of interest.
Yes.
Yeah, etc.
Because we've all heard the stories about, Wall Street organizations betting against their own customers.
And as Arthur says, we're long-term greedy. Our goal is to grow the exchange. And we make a very small commission on every trade. And the best way of growing that exchange, that market, is by being, honest, transparent, giving people the information, not doing any shenanigans, not trading against customers, but being the marketplace, matching you guys, potential market makers, with retail, and that's where we think we can grow the biggest in the long term.
But how do we know your employees not trading?
Well, there's only 10 of us.
Yeah.
Well, you could be trading under the name of your wife.
In the altcoin products, I think I might have used them, but I didn't really notice. For creating the market the same way with the perpetual, do you give credit for adding liquidity?
So yes, so for every BitMEX contract, if you place a passive limit order, you will get a rebate of 0.025%, 2.5 basis points.
So that's across all the
That's
products?
every product. Actually, though, there's some products where it's just free. On our newer, some of the new issue altcoins, the ICOs, it's 0% maker, meaning you don't pay if you add passive liquidity, and it's 25 basis points, or 0.25% for takers. And that's mainly because it's a new market and not as established, so the fees are a little bit higher.
So sorry, I missed that. For the normal markets, it's 0% if you're a maker.
No, you get paid. You get paid. So you get paid 0.025%.
0.25%.
0.025, so 2.5 basis points.
Okay. But if you're a taker,
You pay 7.5 basis points.
So
we make net 5 basis points.
5 basis points. 0.05%.
Yeah.
On the contract value, which is
The notional value, whatever the bigger number that you're
dollars,
trading,
right?
the leverage amount that you're trading. Cool. All right.
Sorry, final question. Like, say we deposit the collateral into BitMEX, right? When we're doing the trading, how do we secure the collateral?
So you
Make
trust
sure,
us.
in terms of security, how to make sure they
so-
they didn't get like stolen or
Right. So
within BitMEX?
no, I as a responsible exchange officer, I cannot sit up here and tell you that there is zero risk of us losing your Bitcoin, but I'll tell you how we have mitigated to what we believe is the best available means. Number one, we are not an exchange per se. We're not a spot exchange. So if you go to Poloniex, you go to another exchange, and you buy something, you expect to get that altcoin immediately. Like, okay, I immediately gave you some Bitcoin. I want my altcoin now. And usually what that means is the exchange needs to operate what we call a hot wallet, meaning a computer program is authorizing that amount of money to go from the exchange to an outside wallet. That is very attractive for nefarious individuals who like to hack an exchange, because that means if, for whatever reason, the security surrounding that server is not good enough, they can essentially steal money programmatically. Now, at BitMEX, we are not a spot exchange. We are a contracts exchange. So we do not give you the ability to get your money in and out whenever you like. We only do it once a day at about 9 p.m. Hong Kong time, and what we use is multi-signature wallets. So that means that 2 of 3 partners need to physically authorize every transaction that leaves our platform. And we're able to do that, number 1, because we only do it once a day. And number 2, we're monitoring, did this person send this address before? Did this person have 2-factor authentication enabled? What's going on with this large withdrawal? And so we check to make sure that our customers aren't getting hacked to the best of our ability. We're making sure that someone isn't trying to spoof accounts and get Bitcoin. But at the end of the day, if you hack this front-end website, there's no Bitcoin on it. There's no, as what we call, private keys on any internet-exposed server. So hacking us, all you can do is shut down our website. You can't get any money. And that is probably the biggest reason why we are a bad target for hackers, because it's a physical verification of withdrawals as opposed to a programmatic verification
That's
of
a
withdrawals.
touch wood, right? Everybody is safe here. Suddenly there's a bomb here, go off. I mean, I think, like, I guess, like...
We have key man risk insurance
Okay.
with AIA, I think. And we have various lock boxes in banks so that in the event of our demise, our customers will still get their Bitcoin.
So don't get any ideas.
So, for withdrawals, it's once a day,
Once a day,
9 p.m.
9 p.m. Hong Kong.
Hong Kong. That's when you will pay out.
Yes.
Okay. And what is, the physical verification, what is that?
No, so what I mean is that we will actually look at withdrawals, and we have to physically go on a method that we use to offline sign. So it's not a press a button and some server is doing all the work for you.
So Poloniex is the basis for a lot of the contract set prices. So they've recently been having some
API issues.
some what?
Some API issues.
Well, not just API, but the entire website, yeah. And so I was wondering how that affects BitMEX.
So yes, we don't like it when our underlying market is unavailable for trading. To this day, Poloniex is still by and far the biggest trader for most of our pairs. So we have stuck by having them as the only pricing source. Now, obviously, if the current situation continues, we'll have to review that decision. But we do have circuit breakers in place such that, let's say that the price drops to 0, right? Some bad tick data. We have protections in place such that our index price doesn't drop as well and liquidate all our customers. Now, we were forced to basically beef up this protection in the event GDAX a few weeks ago had printed a price of 6 cents for 1 Bitcoin. And because they were part of our index, it caused our index price to drop, which caused our market price to drop, which liquidated some customers. And because we value a good trading experience for everyone, we actually paid out all the losses in our own pocket, even though it wasn't our fault. And so we have put in place some other protections to make sure that a similar situation like that doesn't happen again. But let's say if Poloniex was down,
That's down for a couple days.
yeah, we'll switch to Kraken, we'll switch to Bitfinex. So we have the logic in place to dynamically switch to a different provider of index data, and then we'll declare what we call a market disruption event, which means we're changing the terms of the contract while it's trading, and it's only done in extenuating circumstances.
Wait, talking about the risks to the market maker. I mean, for a market maker, you always have billions of risks. For example, big figure trade, off-market transaction, or even wrong price when you enter the prices on your market making API. So for all those risks, can I actually cancel the trade after the trade was done?
No. we are very staunchly opposed to scrubbing trades. And even in the situations where things are not our fault, we don't reverse trades.
Right.
Going back to the question of Poloniex, when they were down, would you consider maybe in the future adding more exchanges?
Yes, definitely.
So
As more exchanges
Yeah.
step up to the plate and equalize trading volume with Poloniex, we will definitely, just like Bitcoin, we'll have an underlying spot price that represents a variety of exchanges, but that hasn't happened yet.
Mm. Because then the impact obviously will be
Exactly,
far
it's
less.
less. Yeah. All right, thank you everyone. And yeah, thanks for coming out. There's some drinks in the back. And if you want to catch the recording of this, we'll put this up on our YouTube channel in a few days as well.